Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the economy, on inflation, and its impact on the equity markets. Over the past few months, really since 2020, since the pandemic, we've been in such a wild macro environment with really unprecedented changes in monetary policy, in economic data. And this is causing a lot of shifts on the charts that we're seeing for the first time since the 1970s, shifts on the bond market that we haven't seen in 40 years. So a lot of people out there, a lot of traders, a lot of investors that are used to a certain type of trading and investing, I think they're missing a couple of very important things that are going to have potentially monstrous consequences on monetary policy and on the global economy. When you have an inflation rate at over 7%, you have to start asking yourself questions. How does it impact the market environment in ways that we haven't seen since the last time inflation was this elevated? A lot of investors have gotten used to simply watching what the Federal Reserve is doing. And I think in a very strong inflation environment, that may not be the wisest thing to do. So by the end of this video, you'll know exactly why you shouldn't just be watching what the Federal Reserve is doing, how other factors are going to have an impact on the market environment, and finally, why what's happening from a monetary standpoint may cause one of the worst downturns we've seen in economic history. And just to clarify, before we dive deep into this fascinating stuff, I do want to clarify that this is not short-term stuff. What I'm going to show you in this video is not applicable to what's happening right now. What I'm going to show you in this video is very likely to have consequences many months from now. This is really big picture stuff. If you haven't seen our recent videos on the stock market, we are still expecting more upside in this bull market. We take a look at a variety of different indicators, of different models to identify the precise moment where we should be adapting our portfolio from risk on and go more towards safety assets. We do that every week on these videos, and we publish our precise research and convictions on our website at gameoftrades.net. Now that I've got that out of the way, let's get right into it. All right, so what happens when you have such strong inflationary readings? What fundamentally changes compared to the environment that we've seen throughout the past 30 to 40 years? And that is that bonds are no longer attractive. We've talked about that many times on this channel, but that's one of the fundamental differences between what's happening now with the inflation that we're having as opposed to anything we've seen throughout our trading or investing career, at least most of us. In an inflationary environment, bonds become fundamentally unattractive. Here we have the 10-year yield, and we're going to take a look at some other bonds, but we have the 10-year yield at 1.75% here. Now it's risen over the past couple of weeks, but this is still deeply negative. We have the inflation rate at 7.1%, while your bond is only yielding 1.75%. So that's a deeply negative bond yield. So what happens when you have an asset that has fundamentally negative yields is that you have a lot of selling pressure. So that's what bond holders are doing right now. Lots of foreign bond holders for US Treasury bonds. The Federal Reserve does not own the entire bond market, at least not yet anyway. And so what's happening right now with these foreign bond holders is that they're selling their assets and they're going into things that are going up, real estate, the stock market, or actually buying gold to protect themselves against that inflation rate. And so what happens is that they push the price of the bonds down, and that pushes the yield higher. And that's quite fascinating stuff, because what usually happens is that the Federal Reserve raises their federal fund rate to push yields higher, right? That's what they typically do. At least that's what they've been doing throughout the past 30 to 40 years. It's through their monetary tightening that they cause yields to rise. That has a contractionary effect on the economy, and it eventually triggers a recession, like in 2007. In 2000, it triggered the dot-com bust. And in 2018, we started to see a downturn before COVID hit, of course. But look at what's happening here, we're seeing bond yields rise dramatically without the Federal Reserve raising the rate whatsoever, at least not yet. But don't you think that this is not monetary tightening, right? Higher yields makes credit demand drop and it makes saving more attractive. And so once rates go a little bit too far, that creates a deflationary effect. You can go ahead and check out some of Stephen Van Meter's video. He talks a lot about this. I think he's a little bit early on the bond trade, but ultimately rising yields has a contractionary effect. And this is what's happening without the Federal Reserve tightening. So I think that's the first mistake that a lot of investors are doing, is not paying attention to what's happening on the bond market and paying too much attention to what the Federal Reserve is doing. In fact, let's take a look at the 2-year yield. Typically, you have the Federal Reserve fund rate rise with the 2-year yield. It happens every time, right? The Fed leads the 2-year yield higher. Now look at what's happening right now. We have the 2-year yield absolutely blasting off without the Federal Reserve beginning to tighten whatsoever. So that's the first real sign here that we're getting that the Fed has lost control. We're seeing monetary tightening through the bond market because bond holders are selling their bonds and pushing those yields higher, right? They're called bond vigilantes. You can go and check out some articles on bond vigilantes. I believe it's Edward Yardeni that coined the name bond vigilantes in the 70s. And we haven't seen them appear throughout the past 30 to 40 years because inflation has been relatively low. So bond holders haven't been selling their bonds aggressively because yields were okay. Now that yields are negative with high inflation, all of a sudden the bond market is in control of monetary policy and the Fed really is becoming irrelevant right now. And that's something that a lot of people online, I think, are not realizing. Now, it's possible we see the Fed hiking rates in 2022. I think a lot of investors are pricing that in. But I think one of the mistakes that might be ahead, and I really strongly suggest you watch out for this, is that bond yields continue to rise aggressively into the 2% range. At least the 2-year yield gets up into this area, and the Federal Reserve doesn't even have time to begin their rate hikes. But the contractionary effect of those rising government bond yields will already have had the impact of a typical monetary tightening cycle without the Federal Reserve having to raise the rate whatsoever. So if we get the 2-year bond yield that goes up to 2% in the next few months, and then the Federal Reserve all of a sudden says, oh no, never mind, we're not doing rate hikes, we don't need them because bond yields are already pretty high. We've already had quite a bit of contraction. Investors who only pay attention to the Federal Reserve are going to be entering the market right at the worst possible moment to be entering the market. And I'm going to show you what I mean. Let me put up a chart of the S&P 500 on top of this, and you'll quickly see that the S&P 500 tops right after the 2-year yield tops. In 1999, the 2-year yield topped a couple of months before the stock market. In 2007, this topping pattern was a couple of months before the S&P 500 top. And in 2018, I don't believe it applies because COVID hit and it prevented a real recession from occurring. We had the shortest recession in economic history because of those very unusual conditions. So they didn't let a top form and a bear market play out. So that's the first part of this video. The Fed has lost control. That's the first point I wanted to make. By the way, if you learned something new with this video, made you think about the markets a little bit differently, make sure to click on that like button. There really is hours of research that goes into making these videos, and it makes it all worth it if you take a couple of seconds to hit the like button. It really helps our videos get pushed out so much. Now I want to discuss exactly why this monetary tightening phenomenon that we're seeing is very likely to eventually lead to one of the worst downturns in history. Not now, not next month, not even a couple of months from now, right? Just as a reminder, a rising 2-year yield like we're seeing now is typically great for the stock market, right? It fuels bull runs. So you don't want to be early getting out of the stock market. There's still room left to run, however crazy that may be. That is our positioning right now. That's not what I'm talking about here. let me put up the consumer confidence. Now, this is the University of Michigan's consumer confidence, and it takes into account two things. It takes into account people's financial situations currently and how optimistic they are about the economy. And here, what we're going to do is look at the relationship between the 2-year yield and the consumer confidence. And you can see here that when the 2-year yield makes a significant peak, like it did here in 1999, it tends to be a peak in consumer confidence, or at least consumer confidence goes down following that peak, right? Because that often triggers monetary tightening, it triggers less favorable financial conditions, and so consumer confidence tends to go down. That's the cycle, right? It happened in 2006 as well. Big peak, period of monetary tightening, peak in consumer confidence, peak in the 2-year yield, and then a drop. Here again in 2018, contraction by the bond market, monetary tightening, peak in yields, peak in consumer confidence, and then it goes down, especially, of course, with COVID in the equation. What's different is that we're seeing the same monetary tightening because of the inflation that we've talked about, but consumer confidence is the lowest it's ever been in a tightening monetary environment. So just by looking at this chart, the purpose of this channel is not to be doom and gloom, but we do look at data, and we do look at data objectively. And if you look the difference between now and 2007, consumer confidence before the recession was great. Now you're going to have monetary tightening conditions in an environment where consumer confidence is already extremely low. That is very worrying for me. It means a lot of people are not ready for a downturn, and yet the downturn seems to inevitably be approaching. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to click on that like button, and of course, subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading, and see you next time.